This is now us trying to get into
Absolutely.
into February. This is what we call habit drop-off week. This is where people usually now all their New Year's resolutions. This is the graveyard. This is what we call the graveyard of resolutions. Nothing ever gets. This is where all those hopes and dreams and fulfillment that you're looking for will never, you will never actually, it will never actually kick off again. At this point, you've got about 2 months. That's what I always say to people. You've got this month and next month to make sure that your New Year's resolutions are all good. All good. Right. Now, let's get kicked off into where our markets ended last week. So that we can actually get into how things are going this week in general. So going into the market outlook from last week, we did see that the Kwacha has continued its slide. There was a little bit of reprieve from that BOZ announcement, which was meant to try and move the needle a little bit. But the reality is what we call currency fatigue, or let me just say currency fatigue, but debt negotiation fatigue. It appears that a lot of the people inside the FX trading world are currently still not sold on where the direction of the country is going and whether we're actually going to be able to get through this negotiation. But we did actually finally start to see the market start to slow down. There is a bit of push and pull finally starting to happen in the FX market, but it's not totally there. I think we all have to be very careful in assuming we are out the woods. I think it is just an early signal from BOZ, and this was the slowest we've ever seen the Kwacha move in a day, like I said, because of push and pull forces. So we only saw it go down by about 0.3%. As of yesterday, but against the Rand, we're still experiencing quite a heavy hand of loss. We're still on around 1.12 and 1.11. So those are some of the areas where we're actually seeing in terms of Rand. Now, looking at commodities, looking at the basic commodities market and how it did close last week, we did see that that oil managed to pick up last week, but then went back down. And the main reason why we saw oil pushing back downwards last week is mainly, Vernon, because we actually saw the US jobs figures actually signal to the market that the Federal Reserve is probably still going to be able to hike strong interest rates because the job market in America is still very strong. We saw 500,000 US jobs added. And therefore, the Federal Reserve, remember, has two mandates: to rein in inflation and stimulate employment. So if inflation is still persistent and employment is strong, the Federal Reserve's only goal then is to now target inflation with every bit of firepower that it can. So evidently what it's signaling to the Federal Reserve is that the job market can still grow even with high interest rates. And that's often what Wall Street have convinced markets of, that it is high interest rates that keep their job market from being able to grow. And I think that's where that's what the markets are basically responding to. We saw the same even with copper. So we saw a lot of the year-to-date gains between copper, oil, everything finally shift downwards. And we saw, or not shift negative, in fact, but have a struggle to actually hold a positive position. So if we look at the key commodities and how they're closing up for the year, we're actually seeing that oil is currently at $80 per barrel. So that's good news for us who are in Zambia. But unfortunately, the US dollar is getting stronger, and copper is starting to fuel down a bit. It's down to 8,929. Remember that copper was sitting at about 9,300 at one point, and all those gains got wiped out on Friday due to strong jobs numbers. Even gold is down to 1,890. So even it has experienced quite a bit of a pullback. When you look at these things year to date in dollars, oil is down 6.5%, copper is up 6.5%, gold is up 3.55%. So all the 5% gains and all those gains are starting to get worn out, and we're also starting to see our FX starting to reverse. So this is similar. This is basically a similar playbook from last year. Except it wasn't the Russia-Ukraine war that's done it. It seems to be the worries and the uncertainty about Federal Reserve policy. That's the main driver here. There's a lot of uncertainty about how Federal Reserve policy will eventually play out. We're also looking, Vernon, that when we're seeing when looking into our bond market, we did see and there is some news that actually might affect our bond market relatively strongly. But when looking at our bond market, we are seeing that we are on the continuous movement upwards in terms of the US, in terms of the Kwacha based bond market. It has continued at zero point 0.9 or zero point 0.6. That's what we're seeing, 0.06 to 0.09 movements upwards year to date. We're still seeing that the bond market in Kwacha, we're still seeing that sorry, not the US, the ZMW bond market in Kwacha is up 3.19% year to date. Now, in terms of US figures, or let me say in terms of yields to maturity, we're still seeing yields to maturity holding at about the point of 23.58. So remember, they dipped as low as 23.3, which means there was buying. Then there was a little bit of a sell-off that flattened out at the end of last week, showing that our markets held at about 23.58. So it was momentary selling. It is still not a full-out sentiment change. And in USD, for the offshore Zambian who's holding their bonds in the country for their potential retirement back or their potential return back, that's what everybody who does. Zambians do two things. They used to do one, but now they do two. If they're looking at trying to create a return to Zambia portfolio, I'm talking about Zambians who live abroad. They used to create a return to Zambia portfolio, and that was mainly done in property. What Zambians would do when they lived abroad was they would just start building flats that they could return to and become a landlord or a landlady. What they're alternatively seeing is an opportunity to also start creating a bond portfolio as well, which they can return to just in case. You don't know what your life is going to be like out there. You don't know if you maybe will not return on time, so you're not too sure. So this is what I always say. There are two types of people who are investing abroad. They're coming in, one, to try and make sure that they have a returning portfolio, and two, also to take advantage of gains that have been made. If you actually look back, Vernon, which is actually quite interesting, if you go back to about 10 years, what you often find when it comes to Zambia and how the Zambian economy has performed, you actually find that over the last 10 years, the Zambian bond market has actually outperformed so many of the huge bond markets around the world. If you look at what we call the 10-year annualized return, in the return in US dollars, and I'm talking about in US dollars, Zambian bonds have actually given a return of 7.56% over the last 10 years. So it's actually been quite strong for people who have invested outside over the last 3 years, with a big kicker where they got 25.2% in US dollars. So for the offshore investor, what they often find is interest rates are very high when the currency is doing very poorly, and interest rates stay low when the currency is doing stable. So it's always offsetting for them. But the one thing they can look at is the 10-year average return of 7.56%, which is similar or higher to the S&P 500. It's actually quite good for most of them who are abroad. And it's also a way to keep their money compounding quick. So there's two options that you are living abroad, you do. And one of the best portfolios a person can have anyway is what we call a property bond portfolio, where you've got a mix of property and bonds. That's the way we've actually seen it. But for the beginning of this year, obviously our property market is taking a bashing. This is what usually happens at the beginning of the year. The bond market will take a bashing along with the stock market, and unfortunately, it's a time where we're seeing a lot of fragility in the markets altogether. Now, one big piece of news which has actually come out at the beginning of the year has got to do with offshore investors and what we call the return of the global bond trader. The return of what we call the yield hunter and the global bond trader. It's actually a good situation for them. Now, why I say this is good for us, it's a good situation for us, but it doesn't mean that we're out of the woods. It appears that offshore investors have bought into the idea that the central banks around the world are finally going to lay off on their rate hiking cycles. So that is their big view, that central banks around the world are going to ease up on huge rate hiking cycles and interest rate hiking. As a result, we're actually seeing record levels of sovereign bond issuance happening around the world. This year, we've seen $61 billion of sovereign bond issuance that was oversubscribed, meaning American investors or investment firms or asset management firms have actually now piled up on as much as they can of high interest US debt. And now they're going around the world seeking alternative ways to start investing. So let's take a look at what they even talked about here. Now, part of what they're mentioning when they're talking about when they're talking about the return of the offshore investor, what we call the yield hunter. It's the same group that we saw who stormed our bond markets back from August to October, before the Federal Reserve started their liftoff of their back in August to October 2021, before the Federal Reserve commenced what we call their liftoff, where they really now just pushed out a lot of where they pushed out a huge cutback on lending rates. A huge hike on lending rates. And as a result, we started to see a lot of companies pull back. A lot of investors pull back on investing abroad. Now, what we're seeing is countries like Mexico, Indonesia. At the beginning of this year, we've actually seen emerging markets who were the biggest hit last year, be it Mexico, be it Indonesia, or any of the major markets, the major emerging markets, are now starting to receive a huge inflow of offshore capital that's actually come back into the market. So this has actually been good news for them. Now, what's happening for us is that, unfortunately, we are still being held back. We can't start yelling victory is done. We're going to start getting lower bond interest rates. No, we're unfortunately still going to be held back because this is not a good situation still for us. Now, I want to make something a little bit clear for people as to what exactly is the major cause here. What's the key driver of our interest rates? And I want to show you something from the banking sector, why it's very important to get our interest rates down, especially for job creation, economic growth, and various things. And this is a chart I picked up off the banking sector of what I call returns on investment on their asset portfolios. Let me just pick this up and put this out and share this for people. This is what we call returns on investment on banking asset portfolios. And you can see here, Vernon, one of the easiest things that you can pick up on is one, if you look at that light blue bar, this is the return on investment that banks are getting from treasury bills. The dark blue line is the return on investment that banks are getting from bonds, and the red line is the return on investment that banks are getting from lending. Okay, so now if you take a look at 2017, what do you see happening? Banks are getting higher interest from their portfolio of treasury bills, and then second was their bonds, and third was their lending portfolio. So let me ask you a simple question, Vernon. You're an individual. Say you've got money that you want to invest. Say you got money that you've saved up and you want to invest. One person is offering you 20% on your money, 20% a year interest on your money, and they're definitely going to pay you back. The other one is saying, can I borrow that money for a little bit longer, but I'm going to give you 19.4, and they're definitely going to pay you back. Like that one, you're certain. Like you can't even question it. The other one is saying, Vernon, I need to borrow your money at 18%, but it's for business, so something can go wrong. Who would you give your money to?
Of course, the guy that's offering at least a 20%.
With the low risk of losing the money. That's yes. The other part. It's not just that. It's the risk of losing your money. So what the problem is, whenever we see government loan interest rates or government securities interest rates too high, the lending rates for business end up becoming too low. So what do banks do? They tell people, look, if I'm getting 20.3% return on investment from my treasury bill portfolio, you as a person who's more risky, we have to add something called a risk premium. So you have to give me more interest to compensate for the probability that you may not repay me back. So always remember that in the short term, you have to beat this light blue line. In the long term, in terms of if you want to take a 4-year bank loan for maybe some piece of machinery for your business, you have to beat this dark blue line. So now if you take a look at 2022 or 2020, look at 2020, 2022, and 2021. Sorry, 2021 and 2022. So if you look at all of this, one thing you can see is that we've seen bond interest rates, bond rates of return. So this is the rate of return that banks are getting from their bond portfolios. You can see in 2020, it got as high as 23%. And in 2021, it got as high as 27%. But the average person, the average loan that was being given out to a business sector, anyone, was 18.6%. So here's where the problems start to come for the banking sector. They have to start issuing loans that beat this because it doesn't make sense to them. So what does the government have to do? And if you look at from 2023, 2022, and 2021, what the first thing they've done is they've lowered short-term interest rates. So look at treasury bill rates. The return on investment from treasury bills has gone from 23.5% to 22.6%, down to 16.3%. And what have we seen this year, Vernon? We've seen an explosion of loans that are going to individuals. We saw it in the last time when I read that banking data, that individuals are starting to get more loans, or households are starting to get more loans, which are usually more short-term in nature, which is building a house, buying a car. It's more short-term loans in nature. It's not even building a house. It's paying for my child's education, all sorts of short-term loans by nature. So the first thing that we've seen is that there is a downward push of interest rates. The problem with this government bonds why these rates of returns for banks are still going to be relatively high, Vernon, is simply because as they grow, and this is what's happening, this portfolio is still stacked with a lot of old government bonds that are maybe 7, 10, and 15 year in nature. So these banks are still making huge returns on these old bonds that they managed to get, which they can trade in and out of very easily, and they can get out in terms of the secondary market. So what we are seeing here is these 27%, 25% rates of return are a result of the long-term ones that got issued at very high interest rates. We're talking about 35% yields, which translate to these 27, 28%. So they're getting the benefits of this. But new bonds being issued are not coming at this high interest rate. So it's going to take some time to get the banks off their bond portfolio. Now, one of the big errors, I think, which we've unfortunately seen when it comes to the sector, is also the amount of bonds that banks are holding. So they're not going to be holding any new bonds. I think that's the good part. I think we can get a hold of that. When they're not going to be holding any new bonds in their portfolio, but they are unfortunately probably going to be holding these old ones, which are going to be doing quite a lot for them. And what we found, by the way, Vernon, is that it's affected their asset book. Their current asset book is very high and very strong. So this is why I said the negotiations we need to start looking at as a country for how our debt is going to be doing and what opportunities we have to bring down our debt are extremely important for the people, because if you want banks to lend to you, Vernon, if you want banks to lend to small businesses, then nobody else is going. Then they have to find interest rates that are more appealing, or they have to find places to be able to put capital that's a bit better. That's a little bit better for the people. So I think that's what we're trying to see as the best option going forward. So that now the news, like I said, the news I wanted to share, which was actually coming out, has to do with the international bond markets, and to start seeing your investors, your offshore investors, having a strong appetite for bonds again, for them having that strong appetite to play the bond market again. That's actually good news, by the way, because that means that the moment we sort out our debt, we actually have a strong group coming back. And here's the story which I just wanted to share very quickly. It says strong investor demand. This is from the Wall Street Journal. It says strong investor demand boosts overseas bond markets. Emerging markets governments such as Mexico, Saudi Arabia, and Mongolia issued a record 61 billion of international bonds in January 2023. EU governments sold $75 billion in bonds in January 2023, and investment-grade corporate bonds being issued at the fastest pace in a month since January 2011 as concerns about recessions fade in the EU and the USA. So effectively, there is the appetite again for offshore investors to return to Zambia. To return to markets where they can get higher yields, because they're suspecting that by the end of this year, they're not going to get much out there in terms of their bond markets, and then they're going to come here and try and see what high interest they can grab a hold of. So that might be able to turn around our exchange rate. That might be able to turn around our business rates. Now, my only concern, not my only concern, one of my other concerns, Vernon, when it comes to this conversation is that we're still in the woods in how to deal with what I call the biggest risk in Zambia, which is the Chimerica rift. China and America are still at each other. And the problem is they have equal say over our debt. One owns half, the other owns the other half. So their fighting prolongs our debt discussions, because China has said, why doesn't the World Bank and these other institutions offer Zambia debt relief? All right, so let's get into some other information. Vernon. But I don't know, what's your take? Whether do you see hope at the end of the line in terms of our bond markets, or in terms of our interest rates, and that's finally being able to get low teen interest rates for investing, low teen interest rates for our businesses. We are seeing banks issuing more new loans to small businesses. We saw small business loans grow from 2.7 billion over the last 2 years up to about 5 billion in terms of new issuance of loans to small businesses. And we've seen households go from 5 billion to 14 billion kwacha worth of new loans issued. And interest rates are a little bit lower now. We've seen that they're starting to come down. You've seen mortgage loans are starting to come down. You've seen certain rates, vehicle asset financing rates are starting to come down into the teens again. I don't know, Vernon. Do you have hope? Or am I the only one who sees maybe there's a twinkle in
I
the
don't know.
sun?
Speaking about hope, seeing how we can grow and increase, the aspect of input when it comes to just small medium enterprises, and when it comes to, issuing loans. If businesses can have at least at the lowest possible, rates that they can borrow money from these banking institutions, that of course will help, grow and just as well empower. Because nowadays, we mostly seemingly want to depend on the CDF to look at issues of empowerment. But I strongly feel the banks also can really contribute just to see that we have more empowered, people, from women to young people, to just get more into entrepreneurship, and also to act as a booster when it comes to, capital, and just ideally capital, access to capital. So some of these entrepreneurs actually have credible and interesting ideas that we couldn't even be facing issues of, electricity today, but due to, access to capital maybe, and just channels on how you can find yourself some monies, and also the conditions and interest rates that actually come into view, that actually could give us a push with regards to just how, the small medium enterprises will be performing. Maybe for bigger institutions, of course, with almost every document required by the banking institutions for them to lend as much money as they need, yes. But for the upcoming ones, also do play an interesting role, especially just to stabilizing of the economy. And we see that small medium enterprises do a lot of imports, and less of exports. And you find that whatever small monies that they can get in our local currency, they have to convert it. As they convert it, ordering and getting whatever goods outside the country, money, depreciates as you convert it into another currency, and you find that you still are in a position where your capital is still small, and the kind of goods that you actually purchase are even, less as compared to what you intended to. So that, of course, I want to believe that would probably enhance, issues around, just the inflation rate. If we can have a bit more of exchange, trade and whatnot, of course, will give us at least light at the end of the tunnel. But of course, the banking sector is doing quite well on our end, seeing how the margin of, profit that they are making. But they should equally look at, making it even easier for other people to access the monies, and like them making more profit. If we can have, they can mock the profit, that's fine. But so long as, people are equally able to access the monies and help businesses grow at the end of the day, because they'll give us updates, of course, on issues of, convertible currencies. But as much as we have less input in regarding, just the trade generally in almost every sector, we'll still be hearing issues of high inflation rate. But if we can have more trade and more people access, capital, more people are able to trade in different and various, commodities at the end of the day, I think that will also push and just, compel the currency, the kwacha, of course, to perform, in a more appeasing manner.
So let's take a look at something you talked about when you said access to capital. All right, and I'm going to share this out with you. This is data when it comes to where banks are getting their revenue from. And this, sorry, let me put that back up. This actually shows where banks are getting their revenue from and why access to capital becomes difficult. As you can see, in 2016, banks were deriving a large quantum of their revenue. This is their total revenue in terms of their interest revenue. When we looked at loans versus government securities, how much they were making, because back in 2016, bond rates were pretty low, and therefore they had to resort to lending to you and me, Vernon, to be able to get the 20% and the 30% interest rate, so whatever they could get as the highest point. But they weren't getting that much from investing in government bonds at that period. So you're seeing that in 2016, you saw that 4.5 billion kwacha of banking revenue was coming in from issuing loans to people versus 1.66 billion that was coming in from issuing loans to the government. So therefore, the more of their portfolio was sitting towards people, and they were making more money that way. Fast forward towards 2020, you can see it equalizes. So the fastest growing part, because unfortunately our government was borrowing money at astronomical rates, they were accepting any interest rates from the government, from the banking sector, and from everyone in general. And because they were accepting such high interest rates in general, they managed to now, everyone started to now shifting towards that. So if you take a look from 2016 to 2020, loans are the loan income that was coming from the private sector had only moved up from 4.55 billion to 5.9 billion. That's not much, Vernon. That's just about a 30% increase. But in the same period, the revenue that they were generating from government bonds almost quadrupled. Okay, it over tripled and it almost quadrupled. It went from 1.66 billion to 5.95 billion. Okay, so we're talking about almost a 300% rise in that income line. Vernon, this is the reality. If you're a business person, where do you put more of your focus? Do you put your focus on the income line that's growing the fastest, or the one that's socially acceptable? These banks are not philanthropies. I know that's what people want to understand. They're not philanthropic organizations. They're businesses with shareholders and profits. And yes, we want them to be socially responsible, but they are first and foremost responsible to their shareholders. That is how this works, because their shareholders are the ones who decide who holds office in their board of directors. Their shareholders are the ones who decide whether the CEO gets to live or die. You see, the shareholders are the ones who decide how things go because they own the business. That's the reality. They have to serve the owner first before they can serve society. Now, they try and make it in the best interest of the owner for them to serve society, but that is a reality. They do some corporate social responsibility, but right now they're going after the fastest growing line. You see, the reality is that government growth if you go back to what I call the populism versus professionalism debate, if you go back to the year 2006 up to 2010, 2009, which is around President Mwanawasa going into President Banda's time, you find that monetary policy expanded very fast. In fact, that same term, 2006 to 2011, Mwanawasa Banda period, what you find is monetary policy expanded fast. But the reality, Vernon, is because the government was very prudent, it did not come in the form of higher interest rates. It didn't come in the form of more borrowing from the government. So as a result, most of that money that was printed or created by the central bank went into banks and went into businesses, causing the fastest business expansion that Zambia has ever seen. We saw the stock market explode. We saw wages go up from 390 kwacha in real terms all the way up to 890 kwacha in real terms. So we're actually seeing with a baseline of 200 and with a base year of 2000. So remember that we adjusted for inflation. The real wages went up from about 390 to 800. So we saw wages increase, jobs increase. The economy grew. The economy grew from 4 billion kwacha to 28 billion kwacha by the year 2013. So the result of that was that the monetary policy, the money that went into the system, when the central bank was creating money, it went into banks and went to businesses because the government backed off and said, we are going to run a prudent government. We are going to mainly rely on taxes. We're not going to be frivolous. We're not going to just do all sorts of things. If we see a project, we're going to have to justify it. And we're going to allow the private sector to be the engine of growth in the economy. Now, fast forward 2016, we get populism that comes in, which is more about appeasing the people. So there's professionalism, which is about doing things correctly or doing things according to technical. But the problem with professionalism the last time is that it overlooked inequality. That's where the problem comes. Yes, this is why I think you've seen this administration has been constantly talking about inclusive growth, because I think they've learned the mistake they made was, yes, the economy grew. Yes, the macroeconomic figures were correct, but we left a huge chunk of the economy at the bottom. And we allowed 1% of the economy to take all the economic gains. And on paper, it looked good, but in society, it created animosity. So that is the reality of professionalism. It has a bad disdain of not managing inequality properly. And this is what, unfortunately, may be happening a little bit again now. Because you see, when you see banking profits from government bonds, that's not social benefit. That's just profits from not lending to the bottom of the economy. That's profits from just basically gaining a lot of money. Now, if you now fast forward to this period, unfortunately, populism may not create more inequality, but what it does do is it creates shared poverty. That's where the problem comes. Okay, because now your government tries to borrow to appease the citizens as much as possible. So what you're seeing here is that when money is injected into the economy under professionalism, businesses grow. And businesses grow, jobs are created, those kind of things, but it happens at the top. When money is injected under populism, government grows. So if you look at that period, what you'll notice, Vernon, is that the real economy under President Mwanawasa Banda term, the real economy grew by over 160%, while government debt only grew by 80. This time, the real economy, loans too. Let me just reword that. That grew by 60%. The real economy grew by 60%. What I mean is that the amount of things being produced, the amount of economic activity grew by 60%. Okay. We also saw that loans to the private sector, that portfolio grew by 160%, while the government debt portfolio only grew by 80%. The budget literally stayed flat. Okay. So this is what happened during that period. Now, let me fast forward to these last 10 years, where what have you seen? You've seen the budget grow from 16 billion kwacha to 180 billion kwacha. Okay. So government has expanded tenfold. Okay. Government is 10 times bigger than it used to be. Okay. Just in this decade. That is huge, Vernon. That's uncontrollable. It's unsustainable. Your government cannot grow that fast. In the same period, if you look at 2016 to 2021, the real economy only grew by 10%. How does your real economy only grow by 10%, but your government has grown 10 times? Okay? That's where the problem is coming. So the government is just vacuuming money out of the economy, and that was the problem. That's what needs to be curtailed, because that's what's creating even worse inequality. Now, what ends up happening as well during that period is that loans to the private sector grew less than doubled, but loan book to the government, Vernon, grew 900%. Okay, 900. That's what it shows you. So the reality is that professionalism leads to expansion of the business sector. Populism leads to expansion of the government. So when you're looking at how these two policies play out for the economy, this is a case example that I'm showing you here of what happens when you have populist policies. Your banks switch from lending to businesses to lending to the government, and if you look at their revenue lines, between 2016 and 2019, they went from making 1.6 billion kwacha lending to the government to 8.73 billion kwacha lending to the economy, lending to the government, and lending to the private sector. They went from 4.5 billion kwacha to 7.54. So you can see the line of revenue that they're generating lending to the government is much more lucrative to the banking sector. It grew still a little bit, but we're trying to work out how to get banks to make more money lending to people as opposed to lending to government. So this is when people start saying the government is not spending money, there's no more money in circulation, all those things. That is because if you want money to get to you and I, Vernon, the government has to stop spending money. Okay? They actually have to slow down. Otherwise, when you see, this is what I don't understand about the Zambia. I think it's because we have a lot of economic literacy problems. Because as a result, what we end up saying is that we don't like the fact that we can't go to a bank and get a loan. Access to capital is tough. Then when the government says, okay, we're going to slow down so that banks can lend you, there's no money in circulation, the government's not lending to us. What do we do? What do we do as people? This is where you just break down and say, what do you want? Because you can't, we're acting like kids. This is the problem. And I have to say this to us as a group of people. We're acting like kids. And this is how kids are. Okay? Mommy, give me ice cream. You eat ice cream. Your stomach is, Mommy, I'm sick. Why did you give me ice cream? That's the way we're behaving. Okay? We have to understand what is progressing and what is happening, especially in the economy. So we have to figure out that right now they're trying to push interest rates down, but there's so many high interest instruments sitting in the economy that it's very difficult to push interest rates down instantly. But if they don't start curtailing their spending, that's not going to happen. Yeah.
So sorry to cut you short. I'm looking at some of the comments on Facebook on some of the audience. This is Kunda who's saying, good morning, guys. Any comment on the meeting the president had with Capital captains of industry on the 3rd of January. This is
Go
according to
on.
social media.
No. I mean, you can see now that this has been a business first government. Okay, they're trying to push business for the purpose of jobs because the majority of people, if you look at the needs of the Zambian people, what are they saying? Economic management, business, loans, and jobs. These are the things that they want to see. The Zambian people want to see job creation. They want to see better economic management, and they want to be able to access capital. That's been the chief complaint that people have. So who do you speak to if you want to try and restructure the economy so that it works in a more sustainable fashion? Speak to the captains of industry. Now, we haven't gotten any feedback on what that means because those are the people who are determining your jobs. Those are the people who are determining how the sectors are going to grow. So why not have the government sit down and talk to them and actually say, look, what is going to come out of this? So how do we do this? What policies will work for you? Now, they have been in consultation with many sectors of the economy. But I don't think it's anything to comment on yet until we get adequate feedback on what the output has been. Now, there's been stuff circulating, but it has not been confirmed. That may be where the issue comes from. We haven't seen any confirmed communiques to come out of what strategies have been implemented out of there. So until we can get some firm communication, because people, let me just be honest with you, we are more interested in getting the information right than getting the information to you first. Okay, so that you can make decisions. You have to have. I leverage off the fact that people are able to trust that what I say is researched, what I say is vetted very carefully. Okay, because they have to be able to make investment decisions off it. So it is a good thing to see consultation between the government and the business sector, so that we start to see, activities happening, so that we actually start to see policies that reflect what the businesses need to grow. The only thing that we should always have is to make sure that we also have small business representation, because unfortunately, big business policy and small business policy are often different. I'll tell you why, Vernon. Big business policy, and it's not to say that they're not consulting with small businesses. I'm just saying in that same room, there has to be some sort of representation. The reason I say this, and not those chamber of this and association, those associations are as bad as the big businesses. I mean, actual people. Either people who are venture capitalists who represent small businesses and have interest in small businesses, or either banks that lend directly to small businesses to be able to see their small business portfolio grow. But at least that's what we want to be seeing. Now, why is this important to make sure you have the voice of the small businesses? Is because big businesses often don't deal with excessive regulation, especially entry-level licensing, as much as small businesses. You see, to a big business, Vernon, the cost of a city council license, or the cost of the fact that we're getting taxed from day one, and all those kind of things, those costs don't reflect to a big business as much, because they're big, they've got cash, they've got all sorts, and even collateral requirements from banks don't bother big businesses that much, because they've got huge cash flows, they've got big collateral, everything. So they're not going to put that at the front of the line. But the small businesses who hire 70% of your economy, the small businesses who hire the majority of your youth, the small businesses who are contributing 25% to the tax, and the small businesses who are one of the biggest contributors to the economy, they don't get a voice, because they're going to tell you, we need lower licensing fees, we need our councils to stop being brutal, we need to make sure that we can find a way to get better collateral agreements, we need better products that serve us. So if you want to try and get this going, what is the questions to answer? Which captains of industry also represent the small businesses? That will be a very important way to see it. But a lot of this is hearsay. A lot of this is speculation. I'm hoping that there's been consultation there. I can't give you the full out there. One more thing, Vernon. I think there is a comment. One more thing I wanted to just quickly share before we wind up today. And we will be going back to our session on the wealth matrix. People still tune in. I'm just giving you some thoughts for the week to think of. Is now I just wanted to share very quickly something I call digital transformation. Data came out recently, Vernon, regarding the payment systems statistics. And payment system statistics showed recently mobile money, firstly, and I just want to quickly put this out. Mobile money is the first ever payment system in Zambia to process 1 billion payments in 1 year as of 2022. It is the first ever to actually do this. And now it's also the first since 2011 to be the payment system that processes over 50% of transaction value in the economy. Over 50% of transaction value. 90% of transactions in this country are mobile money. So 1.5 billion transactions this year, 2022, were done through mobile money, which is 90% of the 1.68 billion transactions that were done. But here's the most important thing I want to show you. Over the last 10 years, Vernon, this is what we call the digital transformation of Zambia. In 2010, 57% of transaction value in Zambia was done by checks. Everyone was getting paid by checks. Almost everything was done by check. And as you can see, 26% of it was done by ATM. People used to withdraw their salaries from ATM. 15% of it was done through electronic transfers by bank, and 0.8% was POS swiping machines. Fast forward 2022, look at what we're seeing. Checks are down to 1.4% of the value transacted. First question, Vernon, who's still using checks? Who's still using checks in 2022? Now I'm trying to think which resistant to change people are these who are refusing to get with the times, who are holding on to their checkbooks. I'm trying to figure out. And like even our business, like they asked us, do you want a checkbook? I looked at my partners and like, for what? What do we need a checkbook for? There's no reason. Internet banking has sorted out so much, and we can use mobile. And also, if you want to make payments to people who are not banked, you can just push the money straight to their mobile accounts now. So don't understand. But anyway, 1.4% of value is done. 10% of value is done through ATM withdrawals. What was so interesting to me, Vernon, is that the Zambian who actually has a bank card does 2/3 of their transactions in swiping. They don't actually even withdraw as much money. So even physical cash moving around the economy is not as high. And also, they move money from their bank to their mobile money and pay people who don't have bank accounts using mobile money. So it's an interesting thing that money is now still staying in the system. And also, if I want to send money from somebody to another mobile money, that national switch is virtualizing money. So this is what I call the virtualization of transactions. If you look at 2010, 83% of transactions were paper-based. In other words, check or withdrawals from ATM. And most of the ATMs are withdrawal, over 90%. But if you look at mobile money, most of the transactions are sending money to each other, or payments of things. It's not withdrawals. So what do you find? Cashless transactions are actually sitting at close to 88% now. So we've gone from 80% paper transactions to 80% cashless transactions in the space of 12 years. So when people say that Zambians are resistant to change, except that 1.4%, they are the resistant to change ones. But when people say Zambians are resistant to change, this begs to differ. This is financial transformation, and the growth of mobile money has been the agent of financial inclusion. And it speaks, Vernon, to one big thing. If your business is running and you don't have point of sale capabilities and you don't have mobile money capabilities, you are actually hindering your ability to do business unless you're a gas station where somebody has to go to you to be able to get. And if you're running a small business and you want people to pay you, you better have a bank account where you can receive electronic funds transfers. You better be able to take POS payments, and you better be able to take mobile money payments, especially if you're dealing with retail clients, because that is going to be the game killer for you if you're not careful. Later on in the week, I'm going to take you through deeper data on how this is going to work, on what are the other data points. But mobile money closed the year with 295 billion kwacha worth of transactions. Electronic funds transfer is about to overtake, what's it called? It's about to overtake, not electronic funds transfer, point of sale. So swiping is about to overtake electronic funds transfer. Zambians are basically going virtual and they're going cashless. And the game is changing. So that's just some data I wanted to give people. There's going to be a whole lot of data coming out this week for coming from payment statistics, more data on banking information. So please tune in to everyone. And we're going to give you, this is the place where you get the information that helps you make investment decisions, Brandon. Helps you make investment decisions.
Absolutely. Thank you so much, Mtwale. We'll be getting to the next particular episodes tomorrow, just to look at even more exciting things around the economy. Thank you so much for your time today.
Thank you very much. And remember, everyone, we're going back to the wealth matrix, your levels of wealth. Have a wonderful day.
Absolutely. Thank you.